Why Warren Buffett avoids cryptocurrency? Lessons every investor should know. Imagine someone offered Warren Buffett a chance to buy all the Bitcoin in the world. Would he buy it? Most people would say yes. After all, Bitcoin is worth trillions of dollars. But Warren Buffett once said, if you offered me all the Bitcoin in the world for $25, I wouldn't take it. Why would one of the greatest investors in history reject an asset that created so many millionaires? In this video, we'll explore Warren Buffett's view on cryptocurrency, the reasoning behind them, what investors can learn from his approach, and whether crypto investors should completely ignore his advice. Understanding Warren Buffett's investment philosophy. Before discussing crypto, we must understand Buffett. Warren Buffett built his fortune using a simple principle: buy productive assets. Examples include businesses, stocks, farmland, real estate. These assets produce cash flows. For example, suppose you own a mango farm. Every year it produces mangoes that can be sold for profit. The farm creates value. Similarly, if you own shares of a company like TCS, the company generates profits. These profits belong to shareholders. Buffett loves assets that continuously produce income. This is the foundation of his investing philosophy. Why Buffett dislikes cryptocurrency? According to Buffett, cryptocurrency does not produce anything. A stock produces earnings, a farm produces crops, a rental property produces rent. But Bitcoin, it simply sits there. Buffett argues the only reason someone buys Bitcoin is because they believe another person will pay more later. That's speculation. He often compares this to buying gold. Gold also doesn't produce cash flow. Yet Buffett believes Bitcoin is even more speculative because its value depends entirely on market demand. His argument is simple. An asset should create value, not merely change hands. The famous rat poison squared comment. One of Buffett's most famous statements about Bitcoin was, Bitcoin is probably rat poison squared. The statement shocked the financial world. Many crypto investors became angry, but Buffett wasn't attacking technology. He was criticizing speculative behavior. During crypto booms, people often buy because prices are rising, not because they understand the asset. Buffett has seen this pattern before: dot-com bubble, housing bubble, meme stock frenzy. Whenever greed takes over, investors stop focusing on fundamentals. That concerns Buffett. Charlie Munger's even stronger criticism. Buffett's longtime business partner, Charlie Munger, was even more critical. Munger called cryptocurrency worthless, dangerous, speculative. He believed crypto encouraged gambling behavior. According to Munger, investing should help allocate capital to productive businesses. Crypto, in his view, does not contribute to economic productivity. While many disagreed, Munger remained firm until the end of his life. Buffett's biggest concern: intrinsic value. One of Buffett's favorite concepts is intrinsic value. Intrinsic value means what is an asset actually worth based on future cash flows. For example, a company earning 100 crores annually has measurable value. A rental building generating rent has measurable value. But how do you calculate Bitcoin's intrinsic value? This is where Buffett struggles. Bitcoin doesn't generate earnings, dividends, rents, interests. Therefore, Buffett says valuation becomes extremely difficult. When valuation becomes impossible, risk increases, and Buffett hates uncertainty. Circle of competence. Another reason Buffett avoids crypto: he doesn't fully understand it. One of his most famous investing principles is stay inside your circle of competence. If Buffett doesn't understand an industry, he simply avoids it. He avoided technology stock for many years, internet companies during the dot-com bubble. Eventually, he invested in Apple after understanding its business model. But cryptocurrency remains outside his comfort zone. This is a valuable lesson. You don't need to invest in everything. You only need to invest in things you understand. What crypto supporters say. To be fair, crypto supporters have strong argument. They believe Bitcoin is digital gold, protection against inflation, decentralized money, limited supply asset. Bitcoin's maximum supply is 21 million coins. Supporters argue scarcity creates value. Many young investors see Bitcoin as a store of value similar to gold. Some also believe blockchain technology will transform finance. These arguments explain why crypto continues attracting investors despite Buffett's criticism. Who has been right so far? This is where things become interesting. Buffett criticized Bitcoin when it traded at much lower levels. Since then, Bitcoin has generated enormous returns. Many crypto investors became millionaires. So, does that mean Buffett was wrong? Not necessary. Buffett never said Bitcoin couldn't rise. He said he couldn't determine its intrinsic value. Those are two different things. Prices can rise drastically even when valuation is uncertain. History shows many assets have done exactly that. The bigger lesson for investors. The real lesson is not buy crypto or never buy crypto. The lesson is know why you are investing. If you are buying because everyone else is buying, that's dangerous. If you are buying because you have done research and understand the risk, that's different. Buffett teaches think independently, focus on value, avoid speculation, stay patient. These principles work whether you are investing in stock, real estate, or cryptocurrency. Warren Buffett's criticism of cryptocurrency comes from his investing philosophy. He prefers assets that produce cash flow, generate earnings, have measurable intrinsic value. Bitcoin doesn't meet this criteria. That's why Buffett stays away. Yet crypto supporters argue that Bitcoin's scarcity and decentralization make it valuable. The debate will likely continue for decades. But regardless of where you stand, one thing is certain. The greatest lesson from Warren Buffett is not about Bitcoin. It's about discipline. Invest only in what you understand. Think long term. Ignore the crowd. And remember, wealth is usually built through patience, not excitement. Because in investing, the biggest return often comes from not chasing trends, but for owning great assets for a very long time. Risk comes from not knowing what you are doing. Warren Buffett.